Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Well, good day, y'all. Ira Epstein of Linn Associates with your agriculture update for this Tuesday, and this is the 2nd of October, 2018, about 1:40 p.m. Central Daylight Time. So as you can see, a nice up day in the grain markets. I think they're still responding to the idea that we have a new trade deal with Canada and Mexico. That looks good. Bad weather in the center of the country, a lot of storms, slowing harvest down to a certain degree. Doesn't mean it won't get in. In fact, if anything, in the corn market today, I saw that FC Stone raised actually the amount of bushels per acre that they're forecasting for the country, and yet the market was able to stay up a little bit. So good news there. A little correction in the energies. Nothing goes in a straight line forever, you know that. And we're getting that type of correction. And this weather, well, they're talking, you know, it's strange. You got the two coasts right now, hot, very hot, and then you get to the center and it's cooler, but that's not going to give a big break to the nat gas because you're still using more than you thought. Now they're going to be focused on whether or not they get the build this week. Well, let's get back to the soybeans. I want you to look at the red line. I call that line the line in the sand. It's the 18-week moving average of closes. And from that, when the market is under it, if it rallies, it's often a resistance point. Back to it, and that's what you've got there. When you break, you might fall to it and you'll challenge it to see what next. You can see how it's done that in the past here, and then when it broke down, it came back, sort of stalled there. So I'm not looking for this market to necessarily pick up and run away, but I am paying attention as a chartist to the fact that the low right here that I'm pointing was 810.5. Now you got an 811.5, and this market's moving out to the upside. When I look at the chart action, you see a slant, if you will, to the upside on it. You've got a pattern of higher lows and higher highs. That is bullish. When you look at the 18-day average of closes, not on the weekly, but now the daily chart, you see how the market on the couple of challenges got right to that zone, wanted to see what it was made out of. You had one move over it, then you pulled back, challenged it. Now you're trying to move up again. What's bothersome is that the market is not taking out this sideways action with the spike one way or the other. It's working on it. That's what I call riding the band. And at the same time, the market is overbought. So you're in a resistance area, in an overbought condition with the trend up. It's the best way to say it. Seasonally speaking, this is the time of year where meal often surprises to the upside. So don't be surprised come another day or two that you'll hear the seasonals are starting to kick in. That doesn't mean the market has to go one way or the other. What I looked at and what I'm looking at is we had an outside day down on Friday. Yesterday we took that day's high out. That tells me you've sprung what I label a bear trap. As long as you don't get back under that low of Friday, I'm going to be looking for support at the 18-day average of closes, which it came down to today and hit. And if the market can poke its head up and through this 316 area, maybe make a run at the upper Bollinger Band. Again, it's very important that you focus on all this sideways action. This will prove to be a base or a top. We'll see which one. Unlike soybeans, you are not overbought, so there's room in this market to move out. Where you've been overbought, you've got to be a bit cautious of, is the soybean oil. 29.50 is the 100-day average. The upper Bollinger Band's 29.66. You literally are right there at the 29. Actually, I take that back. 29.60 is the upper Bollinger Band. You close slightly over it, but you're in that resistance zone in a market that is overbought. What can happen tomorrow is another day of good gain and or consolidation, and you might switch the slow stochastic study to being embedded, which means both numbers will have been over 80 3 days in a row, and until the red line crosses back under 80, one would think that on the pullbacks the market gets bought. So therefore the bean complex itself is looking actually pretty good right here. As I said, in the corn market, they're still talking bigger crops, and yet the market was able to hold up. What would put an end to this party, I think, is getting under 356.5. You do have the pattern of higher lows and higher highs. Also, you had an outside day down on Friday that you yesterday challenged. Now, this was the high, 366.5. 3/4 rather. Yesterday you got to 366.5. Today you took that number out. So I think temporarily what you've got is what? A bear trap. Until you take out the low of Friday, this market's geared to possibly get to that upper Bollinger Band. What I teach, doesn't mean it always happens, is that when you get a bear trap or a bull trap, the first objective is the closest moving average. Obviously, if it's a bear trap above the market, that would be that number, or the closer of a Bollinger Band. It's the Bollinger Band in this case. In the wheat market, a big reversal day to the upside. So we ended the downtrend. Now the question is, do you have an uptrend developing? If you take a look, 505.5 was the break low back here on Friday. The market had a rally yesterday. Today it takes out that 505.5 with a lower low, closes sharply higher. So I'm still going to live with the pattern that I got a lower low and a higher high, but that's the end of this swing to the downside as a chartist. The market might fight a battle at the 18-day average. Should it not and decide to move up, you can see the first resistance is the upper Bollinger Band. Taking out today's low on the other part of that would hurt the chart and set up for a challenge of the Bollinger Band of 499. So the bulls grabbed control. Can they keep it? In the sugar market, you can see the market is in oversold territory. Both numbers are under 20. They were both under 20 on yesterday and the day before. So what we have is a market that now has that embedded reading. One of the things I've learned with embedded readings is always pay attention on that third day if the market's at the top or the bottom of the range, depending if it's bullish or bearish. When it's at the top like this, it implies that when the market's going to reopen, you might lose that embedded reading just like that. If that were the case, then the idea that price and the 18-day average are going to come together becomes a reality in terms of what the chart setup is. Doesn't mean it has to happen again, but that's what I look at. That would be a classic failure capturing a group of people. In coffee, didn't we just say that once this market got over that 18-day average, something that it hadn't done for a long time, it could catch a group? It did it. And the market today soars up 500 points. I don't think the fundamentals have necessarily altered itself that much. This pattern had a long group of shorts in it, and they probably are just buying their way out of the market. You're getting a bit of a rally in the cocoa. Momentum in the market is embedded. It's laid down on that Bollinger Band, and like I just said in sugar, be very careful on the opening. Whenever you close at the top part of a range and you're getting near losing that embedded reading, you always pay attention. So this is a market that I'd watch. If you lose the reading, I'd look for a price in the 18-day average to make a run at each other. In the cotton market, you still have the bearish embedded reading. Nothing has changed on this particular chart until that red number gets over 20. I think the pros will be selling the rallies, still looking for lower prices. The cattle market was interesting today. It reached all the way down and broke through 118.05, the previous break low, went nowhere when it did it.